Hi, everyone. Welcome to the second session of the instant payment series, which is the workshop series number 4. In this session, we are going to have a look at the SEPA Instant Credit, which is a very popular instant payment mechanism in the European Union area. The European payments area started with credit transfers way back in the year 2008. 2009 was when direct debits or DD was introduced. However, it was recently only in 2017 when instant credit was introduced and is now very popular in the single European payments area. We are going to look at the key differences of the credit transfer and the instant credit later on in this session. So what exactly is SEPA Instant Credit? As the name suggests, it's an instant payment instrument for the execution of credit transfers in the Euro region. This is very similar to UPI or IMPS in India, NIP or GIP in Nigeria and Ghana, IPN in Europe, and so on. The messages which are exchanged in a SEPA Instant Credit are ISO XML formats over a high-speed network, resulting in credit to the beneficiary's account in less than 10 seconds. So let's try to understand the flow here. So we talk about a remitter transferring his funds from his PSP A to a beneficiary who has an account with PSP B. Now, we're not taking in names of banks here because it could be any payment service provider. Hence, we have mentioned as a PSP. These PSPs are hooked on to a CSM or a clearing and settlement mechanism agent. Now, the PSP-A's CSM could be different from the CSM provider of PSP-B. So we are not going to discuss too much about CSM. That can be discussed on a separate session altogether. So what does the message flow look like when the remitter initiates his payment? So as soon as the remitter places a request with the PSP-A, PSP-A places an amount block for the transfer amount in his account. It also prepares a payment message, a PAX 008, which immediately gets pushed on to the CSM. The CSM transfers it to the beneficiary or to the CSM of the beneficiary bank or PSP. When the PAX 008 is received by PSPB, it validates the account and timestamp. So this timestamp is an important field in PAX 008. So when PSP-A sends out a PAX 008, it puts the timestamp on which the message at the time the message was sent. The beneficiary validates the timestamp because if it has reached beyond 10 or 20 seconds, it's immediately going to reject it. But if it is within 10 seconds, it's going to accept it. It validates the beneficiary account to see whether it is valid or not. If both are satisfied, it sends back a confirmation PAX 002 back to the CSM, and CSM obviously forwards it back to PSP-A. Now, when the PSP-A receives the PAX 002, it debits the remitter and informs the remitter that it has been remitted. And similarly, the beneficiary would have got a PAX 002 confirmation from the CSM. It credits the amount to the beneficiary. So the whole cycle happens in 10 seconds or at the max 20 seconds. So this is a happy flow wherein the remitter is able to push his funds to the beneficiary. So as we have seen, it involves a PAX 008 being sent out and the CSM or the PSBB sending back a PAX 002 confirmation message. So what happens if it's a reject case? So in a similar scenario, what could be the possible reject scenarios? The CSM can reject if there is a validation failure, if the structure of the message is improper, or there is a delay in receiving the message, that is it beyond the SLA of 10 seconds. Similarly, the beneficiary bank will reject it if the credit account validations fail. in case the beneficiary account number in the message is invalid, or it is closed or dormant, and so on, or there is a delay in receiving the message. So in all these four cases, the CSM or beneficiary bank may reject the message and sends out a pack 002 back with a reject code back to PSPA. So what will the PSPA do? It will remove the amount block, and it informs the remitter that the transaction has failed due to so and so reason, and he may try it again. So now coming on to how this instant credit is different from the SEPA credit transfer. The SEPA credit transfer is like the good old electronic funds transfer, wherein payments are bunched together and sent to the ACH. So the credit may take up to 1 business day, whereas in instant credit, as we have seen, it happens within 10 seconds. Asset is available specific time of the working days, but an instant credit is available 24/7 by 365 days a year. There is absolutely no limit for an SCT, wherein there is a limit of 100,000 euros for instant credit. SCT may have intermediaries, but absolutely there is no intermediaries. It's direct bank-to-bank transfer or a PSP to PSP transfer via 1 or 2 CSMs. It is mandatory for all PSPs to be onboarded to a SCT. However, this is an optional service for PSPs. Now, because it is optional, we have not seen so much uptake on the instant credit. Not many PSPs have signed up for it. Probably the reason could be the exorbitant implementation cost, which comes along with implementing such a solution, wherein you have to deliver payments in 10 seconds. Also, the cost of implementing an AI-based instant AML or fraud detection becomes a bit expensive. Hence, we haven't seen the kind of uptake as a SEPA Instant Credit merits. Thanks a lot for participation in this session. In the next one, we see the hugely popular Unified Payment Interface, or the UPI as it is popularly called, Instant Payment Mechanism of India. Thanks a lot for joining in.